Hello, everybody, and welcome to really important, comes up all the time in the exam, the management of working capital. Okay, and all working capital is our current assets and our current liabilities. What goes into current assets? Things like inventory, receivables, and what goes into current liabilities? Payables. Okay, and of course, we could have cash at bank, or we could have an overdraft. Okay, and it's just how we manage these, and how we manage these all depends on our focus. Is it on profitability or is it on liquidity? Okay, liquidity means I want cash desperately. Okay, so you think about this, right? You're in a business and you want to be really well. We all want to be really profitable, but you're not too worried about being liquid. You're not too worried about getting lots of cash in, and so therefore, what will you do with receivables if you were aiming to be profitable? Okay, would they be high or low? Now, well, what you'll want to be profitable is lots and lots of sales. And one way to attract customers is to say, don't pay me for another 6 months. Okay, that will attract more customers and it will make you more profitable because you have more sales. You won't have any cash, you won't be very good at liquidity, so your liquidity, your cash will be low, but your profitability will be high. Okay, now if you were focused on the other hand on liquidity, saying, look, I really need money to keep my business going, you won't have any receivables. You'll say, look, you have to pay me now. So high receivables would mean you're focusing on profitability. A low receivables policy would mean you're focusing on liquidity. Think about it with inventory. If you want it to be really profitable, you want to make sure you've always got stock to sell. So high inventory would make sure you're profitable. But always having stock to sell means you're gonna have that cash tied up in stock. So high inventory would mean, high inventory would mean you'd have very little money, so you wouldn't be focusing on liquidity. Low stock is when you're focusing on liquidity. Okay, and it's the opposite way round for payables. Right, but we'll come back to that in the next session. I just wanted to mention it now. This really important thing on working capital management is your focus on profitability or liquidity. Anyway, moving on. Let's say, right, that we buy something. Now, when we buy something, it goes into inventory. Okay, and then we sell it. And I'm presuming we sell on credit here. When we sell it, it goes into receivables. Okay, and then we get the cash. We receive cash, thank you very much. Okay, now, because I bought something, I also have to pay for it, don't I? So maybe I get some good credit terms. So my payables is quite long, but still, I have to pay cash here. Now, can you see the problem with this working capital management is that I'm receiving cash here later than I'm paying the cash here. So in order to pay the cash here, I need to get some money because I haven't received anything yet. So this period of time here, I don't have any cash to pay my creditors. I've got to pay my creditors, so I've got to get this cash from somewhere, and that needs funding. The working capital funding problem. That's what generally happens is your inventory and your receivables are bigger than your payables. Not always, you can have a negative one, which is great news, but generally that's what happens. You have to pay people before you actually receive the cash. Now obviously you're going to receive more cash than you're going to pay, so you're going to be profitable, but you need to fund it. And remember what we were saying, if you're focusing on profitability, your inventory days would be really big because you want to make sure that there's stock there. And your receivable days would be really big because you want to try and get customers in. Okay, and so therefore this funding problem, if you're focusing on profitability, gets even bigger. Okay, not so bad if you're focusing on liquidity because your inventory days will be small, your receivables will be small, your payable days will be big, you'll have no problem. So this is generally a problem when you're focusing on profitability. Okay. Now, I just want to write that out in a different way. It's the same idea. We call this, by the way, the working capital cycle, or the cash operating cycle, the cash management cycle sometimes. And so it's basically your inventory days, how long it's in inventory, plus your receivable days, how long it's in receivables, excuse me, minus the fact that you don't have to pay people immediately. That's good. So minus your payable days. That's how long needs funding. That's that figure there, okay? Now, that will need funding out of an overdraft or long-term loans, okay? And the way we do that, again, will depend on things, as we'll see later, but it'll need funding out of long-term loans. Now, the only other question then is, well, how do I calculate these three things? Well, I left days out there till the end on purpose, because how many days are in a year? Hopefully you know, 365. And then you say, right, take my inventory, which is what I want to calculate. Now, where is that on my income statement? Where's the opposite side? Cost of sales. Receivables, I'll take that. Where's the opposite side of that on the income statement? Sales, credit sales. And then payable days, take my payables. Where's the opposite side of that on the income statement? Purchases, or credit purchases. Now in this exam, it's easy. We just put it to cost of sales. Okay, so what it is, it's that plus that minus that. Okay, and that will give you the working capital cycle that will need funding. Okay, you can do more questions in the little mini sessions coming up. I'm not worried with questions yet. I'll leave those to you. Okay, now obviously you want that to be as small as possible, but my question is really, why might that be high? Okay, why might that be high? Well, if that's high, it means that must be high, that must be high, and that must be low, generally. So high plus high minus a low would give me a headache. It would give me a big amount of time to fund. So why? Why might that happen? Because that seems ridiculous. Why don't I always have them low? Well, as we said, firstly, is that my focus was on profitability, not, hopefully you can remember, not liquidity. I was just focused on being profitable. So I got lots of stock in, I got lots of credit days, I gave them away, I gave big credit terms, I had lots of receivables. Okay. Another reason why it might be that might just be poor management, inefficient management of working capital. Okay, I wasn't keeping my eye on the stock levels. I didn't really care. I was letting people pay me whenever. So poor management of working capital, that will also result in a high amount of time with no cash that needs funding. And the other one will be the nature of the business. Because you think about this. Okay, I'm going to give you two businesses. A construction company and a supermarket. Which one of them has a high working capital funding problem and the other one has a low one? So they give a construction company. Will they have lots of inventory? Yes, they will. They'll be tied up. Because they're building something for a long time, they tend to not get paid till later, do they? So they'll have loads of stock, loads of receivables until they eventually get paid. So this would be high. Whereas the supermarket, yes, they have lots of inventory, but they turn it over really quickly generally, and they will have no receivables because generally you just pay them cash, don't you? So a supermarket wouldn't have a high cash operating cycle. Generally, they'll have a very, very low one. Okay, all right. Yeah. So on the other sessions, we'll have a go at doing some figures on this. And focusing a bit more on how we fund it and the costs of funding. All right?